Welcome to the Deep Dive. You know how there's always talk about shaking up old systems?
Mm-hmm.
Well, today, we're plunging into the world of peer-to-peer lending with a company called Brawley.
Right, Brawley.
We've actually got access to their private data room, which is pretty interesting.
Yeah, that gives us a good look under the hood.
So our mission is simple, really.
Yeah.
Figure out what makes Brawley tick, how they're different from the usual lending playbook.
Especially for someone who wants to quickly grasp these innovative financial approaches.
Exactly. Think of it as getting up to speed on a potentially disruptive player fast.
Okay, so digging through their internal docs, investor stuff, even details on their tech partners, what really jumps out is this stated aim to build a different kind of lending experience.
One they say puts people first.
That's the phrase they use, yeah. Finance that puts people first.
Yeah.
So where do we start unwrapping these core principles? What's the foundation?
Okay, so right from the start, Brawley's pitch is about a lending space that's straightforward, safe, and, even friendly.
Friendly, okay, for both sides, borrowers and lenders.
Yeah, both. For borrowers, they're talking fast approvals, flexible options, none of that usual hassle.
Less paperwork mountain, presumably.
Right. And for lenders, it's about getting attractive returns by supporting this community.
Okay, makes sense for peer-to-peer, but what's actually different?
The fee structure. This really made me look twice. A single upfront 5% service fee. That's it. For a 30-day microloan.
Just 5% upfront.
Yep. And get this. 0 interest. No compounding interest. No penalties if you're late paying it back.
Wow, okay, no interest at all. That's unusual.
It really is.
That's a massive departure. Most short-term options, even the ones claiming to be ethical, have some kind of interest. This totally changes the revenue model. It avoids that whole conflict where the lender kind of benefits if you stay in debt longer.
Totally. But then you have to wonder, how do they actually make money and, scale this thing?
Yeah.
Just on that 5%.
Well, that's the million-dollar question, isn't it? It seems this model relies incredibly heavily on volume. Lots of successful short-term loans, and, as we'll get into, super efficient risk assessment.
Okay, high turnover, low friction.
That seems to be the bet.
And on the borrower side, it apparently gets even more supportive if someone's struggling to repay.
Yeah, the documents say they pause any new borrowing for that person, no piling on fees. Instead, they work out a completely fresh plan.
Which is the opposite of adding late fees that just dig the hole deeper.
Exactly. And they make a big deal about these being fixed cost advances. Why is that distinction important compared to, say, revolving credit?
Well, think about a credit card, right? The balance can just keep climbing with interest charges. It snowballs. With Brawley's model, the cost is fixed up front, that 5%. The balance sort of resets with each loan. It gives you predictability.
So it's designed to stop that snowball effect. Makes sense for what they call bridging short-term gaps, not for long-term debt.
Yeah, avoiding those debt traps seems absolutely central to their whole philosophy. Okay, let's flip it. What about the lenders? Peer-to-peer always carries risk, right? How are they protected?
Absolutely, that's a key concern. They talk about protection for community lenders. It looks like a two-pronged approach. First, there's a reserve pool.
Like a buffer?
Exactly, a buffer funded somehow maybe a slice of those fees to cover potential repayment delays first. Then second, they mention an institutional backstop.
Sounds serious. What does that likely mean?
It probably means they have agreements with larger financial institutions, like maybe an insurance partner or another fund that would step in if things got really hairy. It provides another layer of security for lender returns.
Okay, so layers of protection. Makes sense. The docs also buzz about real-time affordability checks using live open banking data and an AI risk engine. Sounds fancy.
It is pretty advanced. Essentially, their AI isn't just looking at your credit score from 6 months ago.
Which can be totally out of date.
Right. By plugging into platforms like Basic with the borrower's consent, obviously they can see, like, current income, recent spending patterns, how much capacity someone actually has right now.
Ah, so it's a live financial snapshot.
Pretty much. This gives them a much clearer, more current picture of whether someone can comfortably handle that repayment in the next 30 days. And they claim this leads to their very low default rates.
Because they're only approving loans people can genuinely afford at that moment.
That's the idea. This data-driven underwriting is, crucial for making their model work and minimizing risk for everyone.
So backing up a bit, their only revenue is that initial 5% fee. They're really hammering the point that they don't profit when people struggle financially.
Yeah, it's a core differentiator they highlight, contrasting themselves sharply with, say, buy now, pay later, or traditional payday lenders where late fees can be a significant profit center.
Okay. They also mentioned something about capital circulating quickly and boosting local economies. How does that actually play out?
Well, because these are short 30-day loans, the money lent out comes back relatively fast, right? It doesn't get locked up for years.
Right, it's a quick cycle.
Brawley argues this rapid circulation means the funds are constantly being redeployed to meet immediate needs. Fixing a car, covering an unexpected bill, often within local communities.
So potentially a more direct, localized economic bump compared to money sitting in like a long-term bond.
That's the theory. The speed of the cycle is what they see as beneficial.
And this shared risk, shared reward model,
Yeah.
what's the thinking there?
Basically, if you're a lender, your money isn't just going to one borrower. It's spread across lots and lots of these small microloans. Diversification.
Like not putting all your eggs in one basket.
Exactly. So if one borrower unfortunately defaults, the hit to any single lender's overall return is tiny, minimized. It kind of aligns everyone's interests, borrowers, lenders, Brawley itself, towards making sure these loans are responsible and get repaid. They frame it as a more humane way to do credit.
It definitely paints a picture of a very different financial setup. Okay, let's shift gears slightly and talk about the engine driving the tech and the infrastructure. They really stress that it's tech-driven, built for now.
Absolutely. Automation and scalability pop up again and again in the materials. That's table stakes for any fintech wanting to grow today, really.
They specifically call out cost-effective efficiency, automating underwriting, risk assessment, using this ML risk engine. What does that mean, practically?
Well, it means fewer humans needing to manually review every single application. Their machine learning engine chews through that real-time data we talked about.
Faster and cheaper.
Faster, cheaper, potentially more consistent, and it cuts down their operational overheads massively. Quick decisions, lean operation, that's the goal.
And then these dynamic real-time adjustments of credit terms using data from BASIC. How's that better for the user?
So BASIC acts like a secure pipe, yeah? Letting Brawley see consented, anonymized financial data from bank accounts. It's a live feed.
Not a static report.
Exactly. So Brawley's system can see if your income suddenly drops or your spending spikes. Based on that live picture, they might adjust your loan limit dynamically.
So they wouldn't just keep offering you the same amount if your situation changed.
Potentially, yes. Or maybe offer slightly different terms. It allows for a much more fluid, responsive approach to making sure the loan stays suitable and manages risk better. It's fairer, theoretically.
That does sound way more adaptive than the old way. The documents also bang the drum about scalable expansion because of all this automation.
Yeah, automation is the scalability key, right?
Yeah.
If you automate onboarding new people, matching lenders and borrowers, handling the payments.
You can handle way more users without hiring thousands of people.
Precisely. It lets them grow, add more users, maybe new products, expand geographically without the costs exploding in proportion. Manual processes just don't scale like that.
And they keep circling back to these dynamic credit assessments. Using that real-time data, it feels like that live financial snapshot is the absolute core.
It really is. It powers the risk engine, enables those dynamic adjustments, and ultimately it's what they believe makes the whole thing responsible and sustainable. Seeing the current picture, not just the history. That's their edge.
Okay, what about actually signing up? They mention a secure and simple onboarding using someone called Frankie1 for KYC and AML compliance. What are KYC and AML?
Right. So Frankie1 is a specialist RegTech company, regulatory technology. They handle the identity checks. KYC is know your customer. Basically proving you are who you say you are.
Like showing your ID, but digitally.
Sort of, yeah. And AML is anti-money laundering checks to make sure the platform isn't being used for shady stuff.
Got it. So Frankie1 handles that verification bit smoothly.
That's the idea. Integrate their platform, automate those checks. It means Brawley can onboard users quickly and easily, but without compromising on crucial security and meeting all those financial regulations. It's a balancing act.
So the tech strategy is all about smooth user experience, but with robust security and compliance baked in.
Exactly. They're using these specialist partners plus their own automation to try and make the whole journey seamless, from applying to repaying while ticking all the safety and legal boxes.
Which brings us neatly to those partners. We've mentioned Frankie1 for the digital ID check and BASIC for the financial data feed.
Yep.
But Monova and Tesiger are also listed. What do they do?
Okay, so the info clearly flags Frankie 1 for KYCML, vital for identity, compliance, fraud prevention. Basic is the engine for that real-time financial data analysis, the affordability insights.
Right.
Manova is specifically mentioned as providing the infrastructure for payment processing, so the actual moving of money securely and efficiently between borrowers and lenders. The plumbing, basically.
Okay, the money pipes? Makes sense. Yeah. And Decider.
Decider is just listed as a tech partner. The documents we looked at didn't really elaborate on their specific function within the Brawley ecosystem. Could be anything from data analytics support to infrastructure components.
Okay, so Frankie 1 is the gatekeeper, Basic is the financial x-ray, Manova handles the cash flow. Got it. So let's zoom out one last time. Brawley's big picture, their overall vision.
Well, the way they put it, the vision is to mesh their ML risk engine with all that automation we've discussed.
To create something efficient and adaptable.
Efficient, adaptable, and, they stress, community-focused. It's about aligning the platform with the needs of both borrowers and lenders.
And the strategic goals behind that.
Lowering their own costs, obviously reducing overhead, ensuring they're always compliant with regulations, and making smarter, faster decisions driven by that real-time data.
And the ultimate aim.
To redefine modern lending. Pretty ambitious.
So wrapping up this deep dive, Brawley's really hanging its hat on a few key things, isn't it? That single upfront fee model, actively trying to stop people getting trapped in debt spirals, using that live real-time data for what sounds like much smarter risk checks.
Yeah, that dynamic assessment is key.
And trying to foster this community feel in finance, which can often feel pretty cold. And they're relying heavily on tech partners like Frankie 1 and Basic to actually make it all work.
That sums it up well. Their model definitely challenges a lot of the norms in short-term lending, particularly around revenue and fees. This focus on, as they say, people first, backed by sophisticated tech for risk and efficiency. It's certainly a different recipe.
It really is a fascinating look into Brawley. You know, thinking about these alternative models trying to prioritize user well-being, transparency. It does make you wonder, doesn't it?
What other areas might be ready for a similar shakeup?
Exactly. What other traditional financial systems are maybe ripe for disruption with that kind of focus? Definitely something to keep watching as fintech keeps evolving so fast.
For sure. Always something new around the corner.
Well, thanks for digging into this with me.
My pleasure. Always interesting to see new approaches.